Dear students, in this class we will see an actual example. It is nominal GDP. The year is 2002 for the US economy. The figures are in billions of dollars. 2002 billions of dollars. GDP was $10,446.2 billion. Of this, the consumption component is 7303.7. Investment component is 1593.2. Government purchases 1972.9. Net exports minus 423.6. So for the US economy in the year 2002, this was GDP. These are the four components. The first component is consumption component. It can be broken down into consumer durable goods, consumer non-durable goods, services, etc. And this constitutes 60 to 70% of GDP. Consumption component accounts for 60 to 70%. The second is investment component. It has three sub-components. One is the business fixed investment, that is business investment on plant and equipment. There is a residential construction investment. We have not discussed this component in detail, but we will consider it later. Residential construction investment, that is construction of apartment buildings, and inventory investments. And in the previous analysis, residential construction investment was ignored. Now, it is the most volatile component. This component, it was 3% of GDP in 1933, became 18.4% in 1950, 18.4% in 1950, etc. So it is the most volatile component of GNP. That is a point which we will see later. And the third one is government purchases of goods and services. But remember this, all the expenditure of the government is not included here. We will consider only expenditure by the government for the purchase of currently produced goods and services only. So we will not include in this government transfer payments in the form of pension, welfare benefits, unemployment benefits, etc. Also, interest income, interest payments by the government is not also included in this. Net export is export minus import. For the US economy in the year 2002, it was negative. So this is GDP and its components. Now we consider what is national income, NI. And it is the income side of national accounts. And in computing national income, our starting point is GNP and not GDP. Our starting point is gross national product, not gross domestic product. And the difference is, in the GNP we consider income earned by the nationals, whether they are working within the nation or outside. GDP is income earned by everyone in the territory. And in the previous class we have discussed how to move from GNP to GDP or from GDP to GNP. So, if we start with GDP, GNP can be obtained by adding the earnings of citizens abroad and subtracting the earnings of foreign nationals within the nation. That is something which we have considered. Now, this is GDP. Now, what is GNP is national income. GNP is equal to, for the US economy, GNP is a little less than GDP minus depreciation is equal to, minus depreciation is 1393.5 will give you NNP, net national product, and this net national product is 0.2. So, from GNP we subtract depreciation, that will give you NNP. Now, minus, from NNP we subtract indirect taxes and others, that is 703.1 will give you national income as 8340.1. So, GNP minus this NNP minus this national income. So, GNP minus depreciation is NNP. NNP minus indirect taxes is national income. National income. So, national income is the sum total of income earned by factors of production by contributing to currently produced goods and services. Currently produced goods and services. But remember this, the difference between national income and NNP is indirect taxes. And as we have discussed in a previous class, NNP is evaluated at market price, national income is evaluated at factor cost. The difference is, one is evaluated at market price, the other one is evaluated at factor cost. That is the difference. Now, we have to see what are the components of national income. Now, national income, components of national income. This national income is 8340.1. Of this, compensation to employees is 5965.5. Compensation to employees. Corporate profits 787.4. Proprietors income 756.5. Rental income of persons is 142.5. Net interest is 684.2. That will give you 8340.1. Of this, the most important component is compensation to employees, constituting 70% of national income, the most important component. When we study aggregate outputs, we will not consider each and every item, but for someone who is calculating national income, each and every item will be considered. But when we use national income accounting for the purpose of developing macroeconomic models, we will make some simplifying statements, simplifying abstractions to make our analysis more simple. Now, this is national income. Now we consider personal income and disposable personal income. And disposable personal income. Personal income and disposable personal income. Now, national income is 8340.1. From national income we subtract 1 corporate profit tax, undistributed profit, valuation adjustment, etc. 353.8. Then contribution to social security 746.5, plus we add to national income transfer payments 1, that is 1288, and personal interest income 394.4. that will give you personal income is equal to 8922.2 personal income. So with to national income we add 2 items, corporate profit tax and undistributed corporate profits and social security contributions, and add transfer payments and interest income, we will get personal income. And from the personal income we subtract personal tax equal to 1111.9. that will give you disposable personal income. Disposable personal income is equal to 7810.9. disposable personal income. Personal income minus personal taxes will give you what is known as disposable personal income. Now, this disposable personal income is divided into what is known as 7810.9 disposable personal income. Of this, personal consumption is 7303.1, loan to business 188.4, transfer to foreigners, etc. 320, and personal savings is equal to 285.9. We will not consider each and every category. Disposable personal income is the two major components which we consider are personal consumption. As you can see, almost 90%. Then personal savings. So we start with the GDP, its components, then national income, its components, then personal income, disposable personal income, and how this income is used for consumption and saving purposes. And in the subsequent classes, we will give some more clarifications to a few more issues associated with the national income accounting.